All right, Jeremy.
Awesome. Apologize for, I'm not sure how to share with PowerPoint, so I'm good with Google Slides, but this particular presentation was in PowerPoint as I found it this morning. I'm like, oh, okay, we'll figure that out. I don't do this as like a braggart sheet, but just more to Taylor's point, giving you an idea of my frame of reference and where I'm coming from. Been doing early stage investing for about 20 years now. Currently at the University of Utah at a group called Sorensen Impact, where we make about 20-ish investments a year into companies that are both doing social impact as well as have the potential for some positive social outcomes. Through that process, I've seen thousands and thousands of companies at the initial pitch and probably done some form of diligence on at least 1,000 companies. So I've seen a lot of different approaches to this. What I'm going to start with in general is by saying that, and I've had some successful outcomes and some really outcomes, and I'm happy to talk about all that in Q&A, right? It's always, any venture investor that says they haven't had any losses is not a venture investor. They are not taking enough risk in my mind. So there's that. But I think, the big takeaway for me over the process of the last 20 years, and especially I would say over the last 10, when I've been much more involved on a more serious basis, is venture is not the right fit for 90+% of the businesses out there. And that's one of the things I want to try to get across today. Like, venture has a very specific use case. And for those companies, it is the only way you're going to get to where you need to be. But by and large, venture for a typical business is a really bad fit. So spend a little time on that. One thing I just want to hit really quickly that ties into where should you think about where you're getting your funding is what are your unit economics, and especially thinking about unit economics now versus unit economics at scale. You think of businesses like an Uber, where unit economics when you're starting out in the market are absolutely horrible. And you can argue, that's always a touchy one, whether they ever right themselves. I will tell you that definitely, having just gotten back from New York, unit economics have started to right themselves in New York. Before, like, all of my Ubers there were at least twice as expensive as the last time I was in New York. So, can you actually take a market and move it forward is something interesting to think about. And the other thing that I don't see a lot of attention being paid in a lot of companies is your sales cycle and what is your cash cycle. And I'm just going to touch these now and then would love to, number one, interrupt me if you want. And number two, really want to try to unpack where people have interest as we get into Q&A. So yeah, and definitely as things pop up, if you want to put it in chat. I won't necessarily do it right now. But we'll definitely get to it at some point. So anyway, sales cycle and cash cycle are super important when you're thinking about how much money you need to raise and when. And that's where I see a lot of companies get upside down. If you are an enterprise company and you're trying to grow like mad, you're spending a lot of money before you actually see cash in the door, even if you're booking revenue. And not understanding the difference between your top line or your, especially forward 12-month revenue numbers, and when you're going to collect the cash and be able to recycle it is super important to being able to think through how much money you need to raise and when. And then the final piece that I mentioned is, is your revenue recurring or one time? If you have a business, in our breakout room at the start, we were really talking about how many early stage founders fail to do a really good competitive analysis before they come in. But also really doing an analysis of your business model. If you have an enterprise sales cycle and it takes a long time, and you collect on the back end, and it's only a one-time revenue, and you're signing up each contract individually, it's not going to recur, then it is really a tough business to scale, and maybe not a business you should be in. And that's certainly not a venture funded business, is what I will say at this point in time. I will definitely hit some of the questions about impact investing. And thanks for the comment, Tara. Well, I said I wasn't going to touch it. Yeah, I think it's just one of those things where any funding discussion ought to start with, why are you trying to fund your business? And the main thing that is left off this slide, which we'll get to here, is growth. So when you're looking to, earlier I said venture has a particular place. If you need hyper growth in your company, if you need to own a big piece of a big market, venture is the only way you're going to get there. Now, maybe you need to wait 5 years in stealth mode, kind of perfecting who your customer is, like how big is that market, what are they willing to pay, all the things that lean models and other things will get across to you. But when you get to the point that pay-per-click has positive unit economics, or your direct sales force has positive unit economics, or you have channel partners that are actually selling, and you know what that is and you quantify it, that is the single best time to take venture money. Number one, it's easiest to raise. If you can go to a VC and say, I know for sure, I have 3 years of data that says I'm going to get $1.50 for every dollar I spend on a pay-per-click ad. That's definitely an interesting thing. All VCs want a 3-to-1 ratio, and I realize that, but anything over 1-to-1 is where a VC starts to thinking about where they really want to invest. And that's an area where if you can just pump money into something and grow it, I think venture is great. For everything else, and I want to walk through the raise more money piece of this. But first of all, coming back to the cash flow focus, reducing your burn is the single biggest way that you can increase the life of your company and be able to figure out what the customer wants. And that involves usually not paying yourself much of a salary, if anything, especially if you're bootstrapping it. You're definitely not paying yourself a salary because you're just moving money from one pocket to the other. But the other people that I mentioned here, so friends and family, angel investors, angel groups, and seed funds. Now, seed funds starts to be venture. So let's discuss that in a minute. But friends and family, angel investors, if you can get them to see a different way, and revenue-based financing is one of the things I'll touch on right now as well. Where as opposed to doing a venture deal where I want 30% of your company for $1 million. Let's have a 3 million post. I'm going to put $1 million into it, and I own 30% afterwards. Instead, if you already have revenues and we can see how money can help scale that, I will give you $1 million, but I get 10% of your revenue this year, 20% next year, and 30% the following year, capped at 3 times return. And that sounds really expensive. And if you look at it in Excel, it looks really, really expensive. If you think about giving up a 30-year company versus that, though, it starts to get really attractive really quickly, because in year 4, you now own 100% of your company again and 100% of your revenues, and you've been able to scale. And to me, thinking through revenue-based financing, some sort of a different risk-adjusted return with friends and family or angel investors, where you all agree this is the goal we want to get out of it. Here's a good return for me. Here's a good way for you to keep the company. Are good ways to get companies to the point where they might be able to venture. But again, coming back to, if you want to take venture, it's usually where you want to push a lot of money through the company, and continue to do it, right? So the other thing about venture, and I'll just speak from my goal, and even with seed funds, you want your companies to grow above all else, right? You are looking for a 10x return if you write a venture check. And I'm just going to stop screen sharing for now. But I can bring it back up if we want. We want a 10x return on at least one of our companies. Now you can look at all the data and it shows that very few companies achieve a 10x return, but you need at least 1 or 2 10x's in a venture fund to be able to make a difference to your LPs. You need a couple of those if you're going to have any hope of having a real carry in the fund as a venture partner. And so once you take a venture check, you need to be focused on growth above all else. And when I say above all else, that means above all the cash metrics and other things I was talking about earlier. So you were thinking about sales to grow revenue. You're not thinking about profitability most of the time. You're really not focused on how you turn around your unit economics. WeWork's the most famous recent example of that, where they continually got more and more money in terms of venture, with the goal that they would have more and more locations and more revenue. And, they were building a cash model where you have variable revenue, month-to-month revenue, with long-term fixed expense in all these office buildings. And it doesn't take much for a displacement in the market to really be able to mess that up. But because they were constantly getting fed more money saying you will grow at all costs, they never worried about how do I try to make that work out. And it, caused their valuation to roughly fall by 10x. So, super interesting to think through business model in your company. And the best way to do that is to buy patient capital, or to get patient capital. That was a whole lot thrown at you. Let me try and summarize what I just tried to stumble through. I believe that most businesses need to focus on patient capital with people that are not hyper-focused on growth, that are focused on a little bit of growth to get to a point where it's profitable, to where you can employ more people, to where you, the owner, can actually take a decent distribution. I don't view a lifestyle business as a bad thing. It can be a bad thing if it's just to help one person out, but if it's really to create a lasting business that's going to stay in the community and employ a lot of people, I think that's a good thing. And I think venture is generally only useful when you've been in business for a while, you understand your unit economics, you understand who your customer is, and you can really drive growth with that money, because then you can keep your investors happy and you can continue to push your goals forward. With that, I'll pause for a minute. So impact investing versus traditional investing. I have a whole nother lecture on this, but I won't pull up the slides in the background. Once you've found an impact investor, you've found an impact investor. I got into the field thinking with a goal to help drive towards some uniform view of what impact investing was. What is impact? How do you quantify social outcomes? The financial piece is easy because we have GAAP accounting, and you can argue about the non-GAAP accounting used by some Silicon Valley firms, but the impact piece, all of us in the field would love to know what that's supposed to look like. But each, homelessness is different than carbon capture, which is different from ocean remediation, which is different from poverty alleviation and financial empowerment. Even within each of those, once you get outside carbon capture, there's not much universally accepted views of what impact is. So what you end up having is a person generally who cares about let's say, financial inclusion and therefore invests in fintech as an impact investor. The biggest difference I will see in impact investing versus traditional investing, we throw out a technical term, is a program related investment. Foundations in the US can use part of their 5% distribution requirement every year to make investments directly into early stage companies, so long as the company meets the foundation's mission. You know, what they're doing is central to the foundation. No portion can be used for lobbying. And the third piece that's trickiest is financial return cannot be your primary goal in making the investment. Primary, the IRS will not clarify, so we don't know what it means. And as a result of that, though, what most impact investors do is usually they are more patient capital, even if they're funding growth. So even if it's impact venture, they will take a longer term time horizon about what kind of how long it will take to get to the return they want. And usually be better about working on restructuring. And, if you don't meet your milestones, then a traditional investor will. But to find, a lot of people who are doing, whether it's med tech or education or some of these other areas where they really are doing some social good, always come to me and ask me, okay, how do I get an impact investor? In my experience, finding an impact investor is really hard because you need to not only find somebody who buys into your business model, but also into your social impact. If you can find one, that's great. But what I would say is go out and look for investors that want to invest in your business idea, that want to help your company grow and scale. And to the extent you can align with them on impact, they're a much better investor because then you're going to be able to, have a more investor driving your savings. So a really good question. And hopefully, Spencer, do you want any more clarification on that or?
Yeah, so on the investor side, I mean, I'm down here in Price, and our goal is to create this additive manufacturing mecca down here. In the end, I mean, in the next 15 years, there's 1,700 jobs that are going to be lost from the coal mines and coal plants shutting down. And so, from my aspect, I'm like, well, is it a social investor that's like, hey, we're trying to, change an economy? Or, I'm not to that point yet, but that's kind of a future thing.
Yeah, so I mean, a couple of things there. Interestingly enough, one of the guys that works for me comes from Elmo and used to work in the mines and now is up here and very acutely aware of it. We've been kicking around the idea of a fund to invest specifically in economies like yours, where it is, let's figure out a way to get manufacturing businesses into places where there's human capital, but not enough capital. And is there a way to link the markets? I think the other area that can get interesting that Sorensen Impact deals with, that I'm trying to get more involved with in general personally, is how do you stack some of the CRA or Community Reinvestment Act capital in with other dollars to be able to invest in businesses like that? And it's, have you come across Patrick Mullen and Stuart Clayson in terms of the Opportunity Zone Acts as well? That's what I figured looking at the nod.
Yeah. Yep.
Yeah. So I think, some of those are possibilities. It hasn't been all it was cracked up to be at the start, to be honest. And there's, some skepticism around the way it's going to work. But one of the things we're trying to do as a group at Sorensen Impact is change the policy to make it easier to use tools like that to be able to invest in communities and do both. It's, opportunity zones are one of those interesting things where the original legislation was really promising. And when Treasury got hold of it, they completely muffed it up for investors. Basically, I don't think they wanted people to take advantage of it, because for those of you that don't know, opportunity zone legislations effectively takes capital gains from an equity portfolio for the most part and allows you to defer the tax on that for 10 years if you invested in certain ways. And in my mind, when Treasury got hold of it, they basically said, we don't want people to use this, so we're going to make it as narrow as possible so it doesn't get used. But that's kind of an aside. All right, sorry, other questions. All right, so pre-profit or bad unit economics, who is a fit for a seed stage investment? Hard to say is the answer. I think seed stage, number one, seed stage doesn't exist in the same format it did in 2008 when I first got involved with Kickstart and some of the other local groups. Seed stage is now honestly more of like a $2 to $3 million round. So, you know, you have some unit economics at that point in time. You have a little bit more of a pre-seed is the pre-seed angel piece, and that's more honestly where you're betting at that point. What you're betting on is team. You're betting on team all the way along. You're saying these people may be able to pull it off. But at the pre-seed stage, like I've seen, the common phrase is an A team with a B idea will likely succeed. A B team with an A idea will likely fail. And so you're really looking at things like, do the founders have relevant experience in the space that they're looking for? Let me give you real companies I've invested in up in Park City. Aaron is, they sell software, if you will, formed by AI, other algorithms that helps a large organizations. And the way they came to me and got credibility was both of the women that founded it had been a value-added reseller for hardware, software in Silicon Valley for the last 25 years and knew all the pain points, which were, you know, they rattled them off. You know, to pull this off, you've got to get the CIO to dedicate 10 hours of their time a week to this process for 4 months. And I'm like, okay, that sounds really expensive. And they're like, yeah, it is. They're like, what our software will do is he can check in for 10 minutes and make sure everything's flowing smoothly and that it seems to make sense to him. And then I'm using people lower down the organization to be able to feed the decisions. And part of it is machine learning about what you have. And so having some real cred within the space that you're trying to solve and what the pain is really, really helpful there. Again, seed stage investability probably needs to be a big market, right? So I've seen a lot of food companies that try to raise venture money, that do raise venture money. I've seen very few that succeed. I mean, there are those that have succeeded, you know, Honest Company and some others. But by and large, I'd say for every one that succeeds, there's another 10,000 that fail. So probably not, even though that's a big market, probably not the best. Software is one of the really good areas to invest in seed stage because the returns can be so huge. And trying to think of anything else on seed stage. So I don't know. Karthik, does help or need some more follow-up on that?
Yeah, I think that was really good. Thank you very much, Jeremy.
Awesome. Yep. Joel, regarding coal-impacted communities. Well, Joel has little, I have too much inside politics on this one, but it's a great question. I think it can be both. So the hard thing I see with coal impacted communities for the most part is distrust of outsiders coming in for good reason. You know, I were controlled by Murray for a while and got whipsawed all the time and not valued as a person, I would have a hard time believing somebody else or another corporation coming in was going to be a good actor. I think the local government can be a resource, but they can be fickle too. I think the best collaborations are going to be between a Spencer and direct investors, and see the local businesses get government on their side, as opposed to using governments as the conduit to find good businesses to invest in. But I don't think that's true everywhere, right? Not a coal impacted community, but thinking of like Boise and Lauren McLean, who's the mayor there now, who I've known for a while now through a bunch of random ways. She's really plugged into the business community there and into the startup community, and understands what's going on a level that's difficult for anybody from the outside to understand. So that would be a great resource where I'd go through government, but it's highly person independent. And I think by and large in the coal communities, you need a local business person who will be trusted by the local people, that can vouch for whoever's coming in from the outside. And I think the business person, number one, has more skin in the game to do that. And number two, has more of an ability to do that than government typically does in my limited experience.
That's
that
awesome,
makes-
Jeremy. I think there are a couple of other questions, and I just want to make sure we're keeping up on our timing for today. But the question from Robin, I think, is a great one to address. It kind of touches on maybe a little bit of what Karthik was doing, and then would love to understand a little bit more of your perspective on Bootstrap versus going out and raising even angel or friends and family. When is that the right time? When do you make that decision to say, okay, we've done enough bootstrapping or not? But if you don't mind addressing Robin's question, and then maybe we can jump into that one.
Yeah, well, I think the two tie in. So let me start backwards, which is bootstrap for as long as you can. And the hard thing is we don't all have financial resources to do that. But the longer you can wait to take any outside money, the longer you can continue to iterate on your business in the way that you feel is most appropriate. And the two hardest things to figure out for any business are who is actually your customer and how much are they willing to pay for it, right? So the longer you can spend in that experimental phase of figuring out both who the customer is and what they're willing to pay for whatever it is you're trying to sell, the better off you are. In my experience, every overnight success is usually a 10 or 15 year overnight success. And they spent the first year to 2 years in some sort of a skunk works, like bootstrap, friends and family situation before they ever raised any outside money. So bootstrap as long as you can. And the other piece to that, the other super important piece to bootstrapping, don't quit your day job. I have a whole thing on this at Rehab Health. The most expensive decision you can make is to give up income coming in while you're working on your discovery. Because then the clock starts ticking and you get in trouble with your spouse if you're married, and there's a lot of stuff that goes with that. But if you can do that while you have your day job and just, you're working 80 hours a week the first time you take outside money anyway, super important. Then to the extent you go to friends and family, being super communicative about this is going to be a long thing. It's not a 3-year return and you get your money back. Like, this is going to take a long time to get to where we need to be. You need to believe in what we're doing, and how long it's going to take to get there. And there's a chance you're going to lose it. You need to understand that too. Don't give me money that you need to live off of, because there's a decent chance this goes to zero. And being judicious about that as well, all the way along. Like, once you start taking outside money, the other thing I will say is think about who you're taking it from as much as the amount. I see too many people get suckered in by a big check from an uncle that is really a pain in the ass. And that is a bad call. Like, you're better off without the money. You're better off spending 6 more months working your current job and trying to figure it out than taking money from somebody that's difficult to deal with. I have been I've now had 4 different experiences with angel investors, or the other people that you have to be really careful with taking money from, figuring out what their reputation is and what kind of personalities they are. I've had at least 4 companies now where I have spent multiple hours on the phone with a single difficult individual who owned less than 0.5% of the company, that was going to force the company into bankruptcy because they had the right to this one provision. And the new funders coming in wanted us to give it up. And it was a minor provision, but they had the legal right to have it. So they were willing to let the company go bankrupt rather than change their mind at all. So, bootstrap as you can. Friends and family money is more expensive than you think because you see them at the Thanksgiving table. So keep that in mind. And then once you get to angel investing and with friends and family, thinking about both personalities as well as the size of the check. Does that seem to sum it up, Taylor?
Yeah, that's
Oh,
super
and
helpful.
pitch deck.
I think that's great and sage, wise advice. To Robin's question about how you best position your company in a pitch deck to raise from friends and family, you touched on a few of those, I think, by setting expectations. Is it different with angel funding? Like, you don't want to go into an angel group and say, don't give me money that you need to live or anything like that. Are there other things that you would suggest when you're positioning your company and pitching to angels?
Yeah, so in your pitch deck in general, the biggest thing to me is, why are you the right person to do it? Again, it goes back to team, and team, location, team, and team. What makes you special that you as a team are going to succeed here? You need to paint the picture that it's a big market, right? Especially if you're taking angel investor money, it needs to be a big enough market, or why you can own 100% of the market. The number one thing not to do, by the way, never, ever, ever, ever show a pitch deck that says this is a huge market. If we only get 1% of it, we're off to the races. I instantly will just say, like, they don't know what they're talking about. Okay, never mind, let's move on. So, it's a big market. We think we can succeed in this market because of X, Y, and Z in our background that's hyper relevant. And I think, in both painting out a picture of, here's the timeline of what we think we can execute on, and how much money, like, the biggest thing I will always ask, but it's nice if it's in the pitch deck. If you're looking at 500 grand, how long does that get me? And what are you going to achieve with that? Do you get to an MVP on the market? Do you get to 1,000 paying customers on that 500 grand? Like, what are you going to achieve with it? In how long? And, realistically, why are you the right people to be able to pull that off?
I think that one's awesome. I'm just taking notes. I think you said 3 never evers, but it might have been 4, but I wrote that down.
It's the Winston Churchill quote. And that's the other truth about entrepreneurship, right? Never, ever, 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 ever give up.
I love it. So
unless you're supposed to fail quickly, to Eric's comment in our breakout room earlier, which I also, if you get there and you get to my earlier example of, this is a really long sales cycle, it's a one-off sale, and it doesn't return that much capital when it's not a big sales amount when I do it, like, stop that quickly. Just get rid of it and move on to something else.
That's good. So another question I had following up with what you said on why are you the right person to do this? I think that is always a key factor, and people always say bet on the jockey or whatever, but in the case where you've been bootstrapping or you are bootstrapping and you're going to the angel round, what should the makeup of that team look like? And I'm asking that question having spent 10 years working with highly trained technicians at the university, like very technical people. Oftentimes they were definitely the right people on the technical side, but as an investor, I've often heard, well, has any of your team ever exited, or have any of them ever done X, Y, and Z? Are there other facets of that why you or your team are the right team that we should be thinking about?
Yeah, number one, never invest in a technical founder. You can invest in a technical founder, but they need to be highly rounded out by business people. And this is my own, I never gave my disclaimer. I am one guy in situations like this. I am totally black and white to make a point. There are gray areas in everything I say, and the gray areas where everything interesting exists, but I'll stay on the black and white for a minute. Technical people want things to be perfect. To make a business succeed, you need to get something out there to figure out what customers like and don't like. It's not about and this, let me tie in Robin's question as well. One of my concerns about a solo founder is it's harder for them to hear the market feedback, right? In their mind, this is the right product, the right approach, it's the right this, it's the right that, and people just don't get that. Now, some of those people go on to be very highly successful, but they usually fail several hundred times first. By and large, a team can kind of round each other out and say, well, wait, what I heard that customer saying was this. Oh, wait, I heard this. Let's go back and ask them what they actually meant with that. And they can get the product further along. And my problem with technical founders is a lot of them believe their approach is 100% right, and you can't make a compromise. You need to have this perfect technical product before you ever want to launch it. And so, back to the exit piece, I really like to see a team that knows their first product's going to be a true minimum viable product. It's not going to be great, but it'll get some market feedback, and allow the technical team to kind of, build it forward as it's going. Harder in, even in med device, you don't have to be perfect to be able to launch V1 of your product. So, I think in general, that's one of my concerns, one with solo founders and two with highly technical people, is their approach is right and they kind of want things to be perfect, as opposed to saying, let's get something out there and see where it goes.
That's awesome. I appreciate all of this. I think time-wise, we're past where we typically end, but this has been awesome. Jeramy, thank you so much for sharing and doing the Q&A. If people have additional questions, can they reach out to you either on LinkedIn or otherwise? What would you suggest?
Yeah, let me just, so it's J Lund at uventurefund.com is the easiest one. Yeah, just reach out by email. You can reach out by LinkedIn. Just make sure if you put in LinkedIn, say, saw your presentation with Taylor today. If you don't personalize it, I just uniformly don't respond because I get a ton of them. But yeah, if you put it there on LinkedIn, I can go through there or just use the email address in chat.
Very cool.
And I echo Robin's comments. Good to see a lot of good faces today. Sorry if you've heard this 2 or 3 times from me, saying basically the same thing, but I do believe in it. So thanks for the attention, everybody.
Thank you, Jeramy. Really appreciate it. We'll see everybody next week. Thanks so much, all.
Thank you.